Hey everybody, welcome back to the show and another edition of 5 Question Friday, where I do my best to answer questions you all have sent in. So let's get right to it. And so the 5 questions today. First, we're going to start with part of the one big beautiful bill, and specifically the $6,000 deduction for seniors, and how we might think about whether that should affect our Roth conversions. And we'll look at a few other potential impacts. We'll talk about how that new deduction works. And then number 2, are short-term bonds a reasonable alternative to intermediate-term bonds, particularly if you're sort of sensitive to the ups and downs of a bond fund when interest rates change? You know, can we go short-term? Is that okay or not? What should we be thinking about? Number 3, what about tax-managed balance funds? Are they okay in a taxable account? By the way, a managed fund or a balanced fund, is really just a mutual fund or ETF that invests in both stocks and bonds. Sort of a generic term. Okay. 4, how should I invest money I'll use to pay rent? So someone sold their house, they've got this money, they're going to use it to pay rent in retirement. How should they invest it? And then 3, someone asked about Roth conversion analysis. We sort of start today with Roth conversions. We end with Roth conversions. The question was, between Boldin and ProjectionLab, which one do I prefer for Roth conversions? And the answer to that may surprise you. So with that, let's dive right in. How should the $6,000 senior deduction, senior citizen deduction, affect Roth conversions? So first of all, let's make sure we know what that is. It just was passed last week, and how it works. And so I'll link to everything I show you. This is from Kiplinger. This is just a table that I think helps explain some things. So the standard deduction has changed, and this right here just means the one big beautiful bill. I don't know what the A stands for, but in any event, that's what that is. And so you can see the new standard deductions are going up. Married filing jointly is $3,150. And then for those 65 and older, now this is not the $6,000 deduction. This is an already existing deduction for folks 65 and older. And it's going up to $2,000 for singles, $3,200 for married filing jointly. One thing you'll note there is it doesn't double. And there are a lot of provisions in this bill, or I guess it's the law now, that have what some will call marriage penalties. You don't get sort of the full credit for being married. Here's one example. It actually comes up in the next thing here, the $6,000 deduction. So this is the deduction that kind of takes the place for President Trump's promise to eliminate taxes on Social Security. So they didn't do that, but the idea behind the deduction is it will, I guess, effectively eliminate some of it, but I really wouldn't think about it in terms of Social Security, because the deduction has nothing to do with whether you're receiving Social Security or not. You could be 65 and not started taking Social Security. You may not even qualify. Maybe you never paid into Social Security, so you don't even qualify for it. You can still get this deduction. You do have to be 65 or older, and it only lasts 4 years right now, 25 this year through 28. And so unless it's extended, it expires after 28. And you have to be 65 or older. If you're married, you can both qualify for it if you're both 65 or older. Important to the question of Roth conversions is that it does phase out. So if you're single, it starts to phase out at $75,000. If you're married, filing jointly, $150,000. And I think with married filing jointly, it completely phases out at $250,000. I think if you're single, it completely phases out at $175,000, I believe. Now, one thing to keep in mind, if you itemize your tax deductions, normally you can't take the standard deduction, right? You don't get that. But if you itemize your deductions, you still can take this $6,000. Should I call it a Social Security deduction? No, we're calling it a new bonus deduction. You can still take the $6,000 bonus deduction even if you itemize your deduction. So keep that in mind. Now, the other thing I'll mention briefly before we get to Roth conversions, and with any tax matters, you should always check me on these, because this stuff is complicated. I do my best to understand them before I record a video. So I think I'm right about this, but I've been wrong before. And that is, I don't believe this deduction will help reduce your modified adjusted gross income, as that might relate to IRMA, those are the additional Medicare premiums you might have to pay, or Affordable Care Act credits. Now, of course, if a person is 65 or older, presumably they're going to be on Medicare, so the ACA credits wouldn't matter. But maybe you're married and one of you's 65 or older, the other's not, and you think, well, we'll get this deduction, that'll lower our income, that'll help us preserve some of the ACA credits for the younger spouse. And I don't believe that's true. Because these deductions are below what they call below the line. You'll find standard deductions and itemized deductions on the second page of your 1040 after your adjusted gross income is calculated. And so it's your adjusted gross income then modified by a few things that actually determines things like qualifying for ACA credits and any IRMA surcharges. So this deduction I don't think is going to affect those items. So sort of keep that in mind. So now, how should we think about this with Roth conversions? Well, the individual that emailed me this question was thinking, should they put off Roth conversions because by doing the Roth conversions, they're going to enter that phase out period of this deduction. So they're going to lose some of this deduction. And I suppose if they converted enough Roth, they might lose it all, right? And so that was their question. And it seems to me, like any Roth conversion analysis, you just got to do the numbers. If doing some amount of a Roth conversion is going to cause you to lose some or all of this $6,000 or possibly $12,000 deduction, if you're married and filing jointly and you both qualify, then what that effectively means is that the tax on the Roth conversion is going to be a bit higher, right, than it otherwise would have been. And so you just have to figure out what that number is and then do the analysis and compare it to what you think your taxes will be. Say if we fast forward to when you start taking required minimum distributions or otherwise start withdrawing money from traditional retirement accounts. So I still think you need to do the analysis. And of course, that raises a big question that I don't think any of us can answer. And that is, will Congress and the president, fast forward to 2028, will they extend this? Will it become permanent? Now, there's just no way to know. Your guess is as good as mine. And that's part of just the difficulty of Roth conversions. We have to make our best guesses. Now, if you're not worried about the phase out, maybe you say, Rob, I'm not going to hit that income level. I'm not going to have to worry about phase outs. Even if I do some Roth conversions, well, then effectively this $6,000 or again, possibly $12,000 standard deduction could decrease your taxes. You could actually potentially use that to fill up even more Roth conversions as one option. Or perhaps just take more money out of a traditional IRA, again, assuming you want to watch for penalties if you're not 59 and a half, or there are other exceptions, but assuming you're older than 59 and a half, it's possible, instead of a Roth conversion, you might choose to just take some more out of a traditional retirement account because you can do it at slightly lower effective taxes. Another consideration for some might be recognizing some gains in a taxable account because you've got this additional deduction you can take. And if you don't have a lot of ordinary income, maybe you've retired but you're not receiving Social Security yet, or it's a relatively small amount relative to the taxes you'd pay, you might end up realizing some gains. So there's a number of different strategies you can use given this new deduction for those 65 or older. But again, you just got to crunch the numbers, and if that's not your thing, talk to your tax professional, your tax preparer, and let them help you. But it does, I think, open up a number of options for folks and different retirement strategies. One thing I'll show you, the retirement planning software, and we'll talk more about it with the last question, but they have not updated, Boldin, ProjectionLab, they've not yet updated for the new tax laws. That's going to take some time. However, I will show you this very quickly. We'll come back to Boldin in a minute. But with both Boldin and ProjectionLab, they have an option where this was before the new law. We weren't sure if the tax cuts from 2017 would stay in effect or not. And you could change, you could say, well, I think after 2025, rates are going to go back up. So let me change to the 2017 tax rates, the higher rates. But of course, we now know that's not going to happen. They're permanent. So if you're using ProjectionLab or Boldin, we would use current rates. By the way, and this is a demo account, but you can see just that change made a big difference. So you want to make sure, again, they haven't updated everything for all the new tax changes, but we can at least get these brackets right. We know that the current brackets in 2025 are staying where they are. They're not going to revert back to the way things were in 2017. And you could do the same thing in ProjectionLab. In fact, I'll just show you that, but in just a minute. So let's get to question number 2. Are short-term bonds a reasonable alternative to intermediate-term bonds? And here's the question. Really, they wanted to know, is it okay, can I use 1 to 3 year duration bonds rather than intermediate-term bonds? And they like the short-term bonds because they're less volatile. They don't go up and down in value as much as intermediate or long-term bonds when interest rates change. And my take on this is that if you're comparing, say, a bond fund that's got a duration of 6 versus 3 years, long-term you would expect the bond fund with a 6-year duration, which is roughly what a total U.S. bond fund has, to be slightly higher. I suspect, though, that at the end of the day, if it gave you more comfort, probably wouldn't change things very, very dramatically. However, I can't actually point to a study that's back-tested that specific question. So that's just my best guess. Now, when we get closer to 1 year duration, and even if we go a little shorter than that and move into T-bills, we do have studies. In fact, the studies show if we put too much, I'll call it cash. So in my mind, cash is basically anything with a duration of less than 1 year. So that would include T-bills. If we put too much in cash, it actually does start to hurt our retirement chances. And in fact, they have a name for it. They call it the cash drag, because cash long-term, even T-bills, just significantly underperforms intermediate-term bonds, and it often, not always, but it often underperforms inflation. In fact, if you go back to like the 70s and early 80s, there were times when, say, a 3-month T-bill outperformed inflation, which was good, right? Kind of like it kind of does now. But there were also periods of time, particularly when inflation got really high, I think 10%, 8%, 9%, 11%, where it not only underperformed inflation, the T-bill 3-month rate, but by a lot. Like we're talking 4 or 5, 6%. And it's easy to sort of forget those things and that those things happen. But long-term cash really sort of drags down the total return of a portfolio. So where I might be comfortable with a three-year duration bond portfolio, I'd get uncomfortable down to 1 and certainly less than that. One article I can show you, and I'll leave a link to this below the video. This is our good friend Bill Bengen. He's been on the show. He's the father of the 4% rule. This is a paper he published 3 years after his 4% rule paper. This was published in 1997. And he actually looked at this. Is cash trashed? Is cash, what's cash do to the portfolio? Let me see if I can find the section here. Here we go. Is cash trash? Right here. And of course you can read it, but in a nutshell, what he said was, if you're going to add cash, 1, don't use it to bring down your stock allocation. That's bad. You can use it as a substitute for some of your bond allocation. And remember, he was using intermediate term bonds. He said that's probably okay as long as it doesn't go above 10%. So you don't want to replace all of your intermediate term bonds with cash. That really will lower your safe withdrawal rate. But the other thing he said was, this is okay to do up to, say, 10%, but assuming you've got a healthy allocation to stocks to begin with. And he was thinking around 60%, because what he said was, in practice, he's found that clients that want a ton of cash also don't want much stocks in their portfolio. So they're like, hey, I only want 25% stocks, and I want, of that 75%, I want 50 of it in cash. I'm really super conservative. And what this paper basically concludes is, yeah, that's not good. So again, I know that's an extreme. I know the viewer wasn't asking that kind of extreme question, but just to underscore, yeah, some cash in the portfolio is okay. You don't want to get too much. The cash drag is going to cause some problems. So that's my take on it. I'll leave links to the article below the video. All right. Next question came from Roland. He said, I currently have VTINX, which is, these are both Vanguard target date retirement funds. I actually own shares of VTINX. But he says, in my non-retirement portfolio, so he owns these in a taxable account. I'm thinking of switching it over to VTMFX. I'm not in a particularly high tax bracket, but I still get hit with a lot of dividends and capital gains. So it's a great question. As a general rule, I don't want to own any sort of balanced funds with stocks and bonds in it, in a taxable account. kind of for the reasons Roland's mentioning. You get hit with taxes. It's not good. But they do offer, and we'll look at it, it's VTMFX is a tax-managed balanced fund with about 50% stocks, 50% bonds, and let's take a look at it. So we'll look at it first in Morningstar. Tell you what, we'll do. We'll look first at one of the two target date funds that he owns, Vanguard Total Retirement 2025, and this is not tax managed. If we go to the portfolio, we can see it's basically 50-50, roughly stocks to bonds. The stocks are 30% U.S., 20% international. And if we want to get a sense as to what the level of dividends and interest at capital gains this is distributing every year, we can go to performance in Morningstar and then come down here and just click distributions. And you'll see in the bar chart, the blue are the dark blue, long-term capital gains. I don't see any light blue here to speak of, but that light blue would be short-term capital gains. Those would be really bad. Maybe this one had a little bit. This had 4 cents, not much, but a little bit. And then the green would be income, in this case, interest and dividends. And you can see it's really quite a lot. If we look at 24, 86 cents per share in long-term capital gains, 55 cents in income. So you're talking over $1.40. And that number in and of itself doesn't tell us anything, right? We have to compare that to the price of a share at the end of 24, which we can see over here, 1872. So we're getting hit with $1.40 on a share worth 1872. That's a significant hit in my view. I would certainly not want to own this in a taxable account. Now, what about the tax managed account? Well, here it is. If we look at the portfolio, it too is roughly 50-50, but there are two big differences. One is obvious here and one is not. The obvious difference is it has no or virtually no international exposure. So that could be a problem depending on your perspective. Now, of course, this could just be one fund across a larger portfolio. Maybe you get your international exposure in your retirement accounts, and that'd be fine. But that's something to note. Now, there's another difference that you can't see very easily. Well, maybe you can. If we go to portfolio, let's go back to the portfolio for the retirement fund. If we look at the bond portfolio, you can see it's kind of like a total bond portfolio. 51% government, 15% corporate, 10 or 11% mortgage-backed securities. They have some cash. I don't know why they have derivatives, but they do. Okay, if we go back to this tax-managed account and we look at bonds, you're going to notice right here, it's 100%, other than a smidge of cash, it's 100% municipal bond funds. That's how it's getting its, that's what it means by tax managed. It's investing in municipal bonds that don't pay federal income tax, and depending on where you live and the municipal bonds in this portfolio, you might get a break on some state income tax. And so that raises two questions. One is, are you comfortable, at least in this particular investment in a taxable account, putting all of your bond investments in municipal bond funds? That might be okay depending on the rest of your portfolio and what you have in retirement accounts, or it may not be. The other thing is, we go back over to Roland's question. He's in the 22% tax bracket. Typically, with municipal bonds, the higher your bracket, the better they are. You can think of municipal bonds as, you want to kind of figure out the tax-adjusted return on a municipal bond, and you can do that. But my hunch is that at 22% tax bracket, and I don't know what a state bracket is, that municipal bonds wouldn't be a great deal. There's actually a tool you can use to calculate sort of the tax-adjusted value of a municipal bond and how that would work out for you. And I will leave a link to it below the video. My hunch at 22%, if I just had to guess off the top of my head, would be, municipal bonds would probably not be my choice. So I know I kind of thrown a lot at you. I can't obviously answer what would be best for Roland. There's too many unknowns and whatnot, but hopefully if you're confronting a similar issue as Roland is, that maybe some of these things that we've talked about will help you sort of get to a solution that's best for you. All right, next question. From Paula, newly retired, selling her home, looking for advice on where to park proceeds from the home sale to contribute a reliable source of income for rent, and importantly, not a fan of annuities. Good. Not a fan of tips bond ladders. Seems to be more work than they're worth. What do I do? So let me first zoom out. I think if you were taking this question to a financial planner that you were hiring to actually help you, they would probably say, okay, good, you've got this home you're going to sell, you got that cash, you have your rent, that's an important expense, but let's zoom out. Let's look at all of your income, all of your assets, all of your investments on the one hand, and all of your expenses, not just your rent, because from a mental accounting perspective, it makes sense to say, I've got this cash that came from selling a home, so now I want to use it to rent, right? To effectively buy a place to live or rent a place to live. And so we're kind of attaching this money we got from the sale to money we'll need for rent. And that might be okay, but it's almost impossible to answer the question without understanding the big picture. And it may or may not make sense to take that money and sort of earmark it just for rent, okay? Because there's obviously a lot of other aspects to retirement planning than just rent. Of course, rent or mortgage is obviously very, very important. So having sort of that caveat, what would I do if I decided, whether it came from selling a home or not, that I have a certain amount of money that I want to use, set aside for rent? Now, the first question would be, for how long? Are we talking about for the next 30 years? Are we talking about for the next 5, maybe until Social Security kicks in? Again, these are questions that you have to answer, or at least think about. So that brings me sort of to the final sort of aspect of this, and that is, if you want some kind of secure, safe investment, but you don't like tips ladders, particularly when you have to go out and buy individual tips, what are your options? Well, I'll give you 2 to at least think about, and this is not specific to taking money from a sale of a house and saving it for rent. You might use this for any important expense that you have for some period of time. So let's take a look at 2 options. The first is, here we go. I'm looking at BlackRock. They have a product called, they're actually called I-bond ETFs, which I've mentioned this before. Terrible name because it confuses people. This is not the I-bonds that you can buy from Treasury Direct in the US government. This is an ETF and a type of ETF that BlackRock sells. And the way these ETFs work, and we're looking at TIPS versions, is that when you invest in one, take the 2030 down here. If we bought shares of that today, we could hold it to 2030, and then in about October of that year, they will have sold all of the bonds. All of the bonds in that ETF would have matured, and they give you your cash. There you go. Thank you for investing. The investment's over now. It's terminated. Most ETFs and mutual funds are perpetual. They don't have an end date. But with BlackRock's I-bond ETFs, they have an end date. They end. They're over, they're done, they're closed, and they give the money back. And between now and then, you get interest. Now, of course, you can always choose to sell the ETF sooner. If you do that, you might sell at a premium to the net to the value of the bond, the face value of the bonds, or at a discount, depending on what interest rates have done. But if you hold to maturity, it's just like owning an individual bond. And so you could, and I know Paula said she doesn't want tips ladders, so I'll say here, you could create a tips ladder using ETFs instead of individual bonds, which would make it easier. The downside is you can only go out 10 years. That's as far out as they go, 2035. And now next year, I'm assuming they'll offer 2036. So you could sort of do a rolling tips ladder, I suppose. But if you were looking for a 30-year solution, you would need individual tips to do that, to go out 30 years. But this is one option. An even simpler option would be something like this. This is the Vanguard short-term inflation-protected securities. This is a mutual fund. They also have an ETF version that you could purchase if you prefer. It's short term. The duration, I was just at it here a second ago, and I scrolled up. Where is it? Portfolio composition. The effective duration is 2.5 years. So you could think of that as if interest rates went up by 1%, the value of this fund would go down by roughly 2.4%. So again, it's sensitive to interest rates to a point, but the risk is not significant. This is a pretty safe fund, but again, I don't want to suggest that it can't go down in value. It can. My only caution here, and this is kind of how I started the response to her question, is you really need to understand the big picture of your plan, all of your income and assets and investments and all of your expenses. Because if someone said to me, I want to pay rent and I want to have money set aside for rent for the next 30 years, and I want to put it all in this fund, to me, that's just too conservative. It may feel safe, but I would view that as a bit too conservative. It's because this fund is different than building out a 30-year tips ladder. If you build out a 30-year tips ladder, you know exactly what you're going to get on an after inflation basis for 30 years. That's different. So again, it's a weighing complexity, I suppose, with more assurance as to how things are going to unfold for you. Hope that helps, makes sense. Yeah, I'll leave links to this below the video. All right, last question. I hear a round of applause when I say that. Yes, thank goodness, it's the last one. All right, James wants to know, from a Roth conversion perspective, from planning, what do I like better, Boldin or ProjectionLab? I told you that my answer here might surprise you. So let's start with Boldin. This is Boldin. There's one aspect of Boldin that I like that ProjectionLab doesn't even offer. So if you like this feature, Boldin is the answer. But I will tell you, there's another part of ProjectionLab that I like a lot better than Boldin. So we'll look at both of them. The thing that Boldin offers, we can go to Explorers down here. And by the way, this is a demo account. Go to Roth conversions. They have a Roth conversion tool where I can say, okay, I've got 100,000 in this Roth conversion, and I want to come up with a Roth conversion plan. And they have 4 options. I can say, well, I want to convert up to a certain tax bracket, up to a certain IRMA bracket, highest estate value, lowest lifetime tax liability. I tend to use the tax bracket limit, but you could test all 4, right? So if we pick that, and we'll say we want to, I don't know if this will generate any conversions, but we'll start with the 12%. Is it okay to pay the tax liability of Roth conversions with converted funds? I generally say no. Do you want to retain a minimum amount of after-tax accounts? So in other words, you don't want Boldin to drain all of your taxable accounts. Normally I would pick something, some amount, but I'm going to leave that blank just to see if we get any conversions out of this. And then you can set specific dates. I'm not going to do that. And we'll see what happens. Okay, we got one big conversion here and some small conversions there. That was its optimized plan. And I'm glad it did this, because this is a perfect example of where I look at this and I think, well, that's odd. Why don't we spread this out? Now, we could figure that out. But it would probably take some time. We'd have to dive into the tax analysis for Boldin, and we could do that. And in fact, even if this were spread out more evenly, I would do that. I would take this sort of as an initial, okay, I see what they're recommending, but now I want to look at this year by year. So I might add this to my plan, maybe, or more likely an alternative, a scenario. You can create a second version of your plan. And then I would start playing with the numbers, all of the different years. Now, I'll show you how to do that. But before that, let's just go back here and let's bump it up to 22%. Okay, at 22%, and that might explain the reason. We were only going up to 12%, and these years here, we'd already hit the 12% with our other income. Again, we could have figured that out if we took the time to look at the insights and the tax. But given what we see here at a 22% limit, that's got to be the answer, right? So what we could do, and you could see here, by the way, and this is, again, ProjectionLab doesn't even offer this. So if you see this and you say, yeah, Rob, this is what I want, the analysis is over. You're going to use Boldin. You get your effective federal tax rate comparison, your tax liability, how it affects IRMA, you get all of this sort of data, right? And so that's, I think, a really helpful analysis. And if you said, yeah, I like this, I'm going to apply it to my scenario, you can just hit there. It gives you some warnings. One, to keep a record of your existing conversions. You can create a scenario. We don't need to do that. I'll just apply the changes. And when the plan's updated, it takes us to money flow, which is right here. And here are the transfers. We could delete them, right? In 5 clicks, boom, 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 I could delete them. The other thing I can do is I could edit them. I could say, I don't know if that's how much I want to convert. So I can make changes to it. So I think Boldin's approach to Roth conversion analysis is really good. Now, as I said, though, there is an aspect of ProjectionLab that I like too. They don't give you that fancy tool. So if that's what you want, Boldin's the answer. But what does ProjectionLab do? So ProjectionLab, and we're again in a demo plan, there are 2 aspects to ProjectionLab that I really like that Boldin doesn't do. All right. The first is, before we even get to testing some Roth conversions, we can go to compare and run a what if. We can put the system into a what if mode. You can see now it says compare, there's a red dot. And what that does is it allows us to make changes to the plan and see them in real time. I really like that, just generally, beyond just Roth conversions. But then we can go to Roth conversions. So to do that, we go to any traditional retirement account we have in our list of accounts here. I only have one in this demo account. And then we come down here and we toggle on the Roth conversions. And what I like about this, and we're going to edit this, or maybe we won't have to, but you'll notice down here, you see the baseline, that is the plan with no Roth conversions, compared to the Roth conversions. And it says lifetime taxes. They go down by $75,000. Again, the numbers are small. Apologies if you can't see it. Total converted is, in this case, about $408,000. You can see that if I edit this. And what I did was I decided to do Roth conversions for over a 13-year period. I decided to convert $40,000 a year. All of this can be changed. And you'll notice 40,000 times 13 is not $408,000 and change, but this is I think what they're doing is a present value. So that's why the number looks a little different. Shows you the years of conversion. It shows you, I like this a lot, the first RMD. Again, Boldin showed you this too in chart form. So, again, both programs offer this just in a different user interface. It shows you how it's going to go down. Final net worth is going to go up. And EW is early withdrawal. ProjectionLab will alert you if your plan is calling for, say, a withdrawal from a 401k at age 58 or something. In this case, there aren't any. And I could change all of this. If I said, well, I think I'm only going to go 12 years. Let's just do 12 years, and I can see the differences. The other thing I can do is if I save this. So right now, I can make all these changes here, and it hasn't actually been added to my plan. I could go back and forth, change this as much as I want, and then once I'm ready to see what it looks like in my plan, I can save it. And you can see here in real time, year by year, what's changed. If I hover over one, the taxes with Roth conversions this year would be $10,000 and change. The baseline before Roth conversions, again, the numbers are small, but trust me, it says $14,200. I can go to my end of my plan and see the difference in net worth. This is just tax breakdown, but if I click the arrow there, I can look at so many different things. Stacked net worth doesn't change my stacked net worth by a lot, but I can see the changes. Let's see. Tax breakdown, I think we were just looking at that. What else might we want to look at? Oh, changes in net worth. We could look at that. So we could look at how it's affecting our plan, and then we could either keep the changes, sort of apply them to this base plan, or we could save it as a new plan, or we could just throw them all out and start over or do something else and revert the changes. The other thing I'll mention is that the tax analytics here, I really just like the way it looks. And the taxes here, you get legacy and final net worth. You get different cards up here. Medicare, if this had triggered additional IRMA charges, that would show up. And you can also pick the metrics that you want to show here, maybe taxable income. Okay, there you go. So I really like the user interface of ProjectionLab. The other thing I'll show you, if we revert the changes, so we're going to erase the Roth conversions for a moment, you'll notice that in these early years, there's no taxes. There's Medicare starts when the hypothetical couple here, they both turn 65 the same year. But there's no taxes until 75, which just happens to be when RMDs start. And so if I were modeling Roth conversions, I would look at this as sort of prime real estate, prime opportunity to do Roth conversions, right? And you can actually look at income and even marginal rates and other things to see what's the income and why am I not generating any taxes in those first 12 years. In fact, if we go to the plan, you can also look at some taxes here, taxable income breakdown, and I can see what's going on each year. So, oh, I see, I have some realized gains because we're selling some taxable investments to live on, but the standard deduction is more than taking care of that. And then some Social Security kicks in, that might change some things. Obviously, the RMDs start here. So at the end of the day, I really like Boldin and ProjectionLab. They're great tools. I personally use them both. I know that probably doesn't make sense for most folks. I also do YouTube videos about them, so that's part of it. But I think if you want a tool that sort of does the initial analysis for you first, Boldin is the answer. If you're not going to use that and you really like the interface of ProjectionLab, as I do, again, I think Boldin's is great as well. ProjectionLab, though, I would put it just a tad ahead of Boldin in this regard, in my view, then maybe ProjectionLab is for you. So hopefully that sort of quick run through helps you. Obviously, if you have any questions, leave them in the comments below the video. I'll leave links to everything I've shown you below the video. And until next time, remember, the best thing money can buy is a shorter video, really. This one went too long. I got to be honest. I'm just saying. But financial freedom.